Good morning, trading world. It is May 2nd, 2022, 7:45 a.m. and this is my pre-market outlook and technical analysis for day trading the SPY. The title for today's outlook: do you really need to see selling continue in order to understand the market is broken? Also, dollar versus risk assets. Right now, I feel like it should be understood that the market is broken. However, I often use the analogy as the market as being a runner running a marathon. While running this marathon, we understand that no runner can run forever. So we know that there will be a planned water break and rest periods. Water breaks and rest periods in the market's case are consolidation periods and bounces. And what many traders consider bounces are still consolidation periods on a higher time frame. We are at or near one of those planned water breaks, so I expect to see some consolidation showing more prominent on or after the 5th of May. I have often recently said that the dollar could be used as another VIX when the real VIX lags. The reason for this is when all are fearful across the globe, there is still no better trusted currency than the dollar. If you don't believe me, just take a look. Alright, what you're looking at right now is a 1 year, 1 day chart of the euro futures, mini futures to be exact. And you can see right now we've been pretty much in crash mode for some time now in the euro. Excuse me. Now here we have a 1 year, 1 day chart of the yen. And as you can see, since March, this has been pretty much in full crash mode. Alright, the last one, I'm not going to go there. Plenty of other currencies. We can look at pretty much all currencies, but I'm not going to waste a whole lot of time going around. But the last is the dollar. And as you can see, it is the complete opposite of the euro and the yen. So when trouble is abroad across the world, everybody still trusts the dollar and everybody is still running to the dollar. Something else to think about with the dollar. Every risk asset or equity is measured or traded in dollars. So essentially, when you're trading, whatever it is you're trading, it's almost a pairs trade because it's that versus the dollar as well. And if you think about the leverage ratio of the dollar, this can be seen throughout everything. So using the current pullback of the dollar, we can kind of get a very rough estimate of where we could bounce or consolidate to. And it's not quite the pullback as of yet, but me see if I can get this accurately. So if we take the top down to the low, can't see it. Okay, here we go. The dollar has had a fall of about 1.8%. Now, the leverage ratio used to be about, I think it was close to 1 to 5. All right, if we take this 1.08%, this pullback that we have in the dollar, and I don't think we're done yet as far as this pullback on the dollar. We're going to end up coming down some more. So this is not where I really want to take the measurements for, because I definitely feel like we have a little more fall in the dollar. But if you take that 1.08% and the leverage ratio used to be 1 to 5, so it's like dividing it by 0.20. Let's bring up the SPY. That gives us a figure of about 5.4%. And what you would do is take that 5.4% let me do this again. From the bottom here, and that 5.4%. Forgive me, I haven't done this in a long time, but I'm not even sure what the ratio is right now due to inflation. But the last time I did it, it was around about 1 to 5. But this could give us a rough estimate of where this bounce may be headed to, which could be up in the 430s. So that's something to kind of pay attention to when it comes to the dollar, because everything is priced in dollars and we have to kind of consider the impact that the dollar itself has on risk assets. Again, this is nothing to hang your hat on, but it's just more evidence of the bounce coming. Now, with all this said, don't be surprised to this morning, if we have a decent sized gap down, or we head down the first part of the session. There may be some leftover price action from Friday, because we were right on the brink of having to do this dynamic hedging, and a little bit of it may have started and just may not have caught up in the order flow as of yet, but we could still be dealing with a little bit of that at the open this morning. Looking out at the month of May has a bullish bias or main thesis closing above 412, with a possible retracement of about 442 or somewhere in that area. Now, the weekly outlook also has a bullish bias or main thesis closing above 412, with a possible retracement of the 420 area. Now, relax. The retracement estimates are just quantitative estimates. Nothing says we have to go there. All right, here we go with the key levels of the day. Starting on the resistance side, we have jack resistance at 414 to 415, queen resistance at 416 to 417 area, and king resistance at 419 all the way up to 423 area. On the support side, we have jack support at 412 down to the 411 area. Queen support is going to be the 410 down to the 409 area. And king support is 408 all the way down to the 404 area. The main thesis for today is bullish, closing above the 412 area with a projected high or target of 417 to 423. The alternate thesis is bearish, closing below 412 with a projected low or target of 410 down to 404. Keep in mind, days like this with the VIX above 30, we can see both the alternate and main thesis. It's also a day that the alternate thesis could be much more explosive if this happens alone. The current channel we are in the major channel that we're in is 416 all the way down to 397, with the minor channel being 414 down to 404. Let's take a look at the scenarios of the day. All right, the first scenario, which could be our expansive range day structure, we could look to set a decision area lower boundary around the jack or queen support area before bouncing higher, and then visit back to the middle of the range. This is what I was kind of speaking of with the VIX this high. We could pretty much get a combined or a combination of the main and alternate thesis touching pretty much both target areas. It definitely is possible with the VIX over 30. The second scenario could be our rounded reversal day type structure. We could get a continued push lower toward the queen or king support area and find midday chop around either that queen or king support area before spending the same energy we used coming down to go back up the second half of the day. Also, with the rounded reversal day type structure, let's be aware of the vice versa scenario. So we could get something like this as well, where we go up instead of down first. But to me, it is likeliest that we head down. I was thinking about this all Friday. I had short positions on Friday, and I took most of them off, but thinking about how we could possibly continue, since we were so close to the market maker's expected move and having to dynamically hedge outside of it. I left a couple out of the money puts on just in case. So interested to see how that's going to play out after the open. But that's our rounded reversal day type structure. Let me bring up the last scenario. All right, our last scenario could be our trend day down. We could open, gap down, start with a slight rally back towards the previous close on Friday. We find resistance on or before that previous close, then begin the downtrend for the morning. We find midday chop around either the possible queen or king resistance area, and then the last part of the day, or the second half of the day, we could usually begin with a head fake, faking that continuing trend down, and then a pullback going into the close. So those are the scenarios for today. This week is going to be, especially these next 2 days, are going to be very, very awkward for me. Being that this is the first of the month, we should have new fund flows. But the market right now is so broken that new fund flows may not even be able to hold things up. I do show that sell side activity somewhat continues into this week, but we should still have a bullish ending toward the week, or toward the end of the week, leading into a bounce that we'll have starting maybe next week. So just keep that in mind. This is still a pretty much dangerous area and dangerous time to be caught and not be properly hedged and not know the risk of your positions. Because again, remember, markets don't crash from overbought areas. They crash from oversold areas when people decide to give up and throw in the towel on the buy-in side of it. And then we have that explosive alternate thesis that kind of takes everybody by surprise. So just keep that in mind. As always, please know and understand your risk. And wishing you a positive trading day. Have a great one.